All right, I think we can start with the monetary policy panel that is starting now, and the theme is maintaining monetary stability in the period of heightened uncertainty and restrictions on capital flows. For those guys who were present yesterday, the fiscal panel will try to maintain the same plan, so we will focus on three general topics on this panel and also try to leave some time for Q&A from the audience. So today we will focus first on contemporaneous challenges in the area of monetary policy. Then we'll focus more on the risks from different angles. And then at the end, we'll talk more about monetary policy frameworks and different central bank policies. And it is my great pleasure to have at the panel Mr. Philip Lane, who is the member of the executive board of the ECB and the chief economist. Philip was unfortunately unable to join us present in Belgrade because of the conflict in his schedule, but he should be online. Philip, can you hear us?
Good afternoon.
Excellent, very well. Regards from Belgrade and looking forward to this panel. We also have Ms. Ana Ivkovic, the Vice Governor of the National Bank of Serbia. Unfortunately, the Governor, Ms. Tabakovic, couldn't make the panel because of some small injury. And Ana, and thanks to the National Bank of Serbia for swiftly reacting and having Ana here at the panel. And also we have Mr. Lavretnovsky, the representative of the IMF for Serbia. So without further ado, let's start. If we look at uncertainty as such, it has been a topic in academia and in policy for a long time, and especially became important after the global financial crisis of 2008, 2009. However, we mostly talked about economic uncertainty, but what we see at the moment are different other types of uncertainty. And Philip, we can start with you. How do you see the central banks assessing and also communicating risks which are related not only to economic uncertainty, but also related to geopolitical, institutional, national security uncertainty that has been in the headlines over the past few years?
So, as you just said, I mean, the literature about making policy under uncertainty has been around for decades. But typically that has been uncertainty about the shocks hitting the economy and also how the system responds to a shock. But as you indicated, now we have changes in the geopolitical order. We have possibly more kind of a weaponization of international trade and international finance. And what this means is that we do have to think about risk in a different way. In particular, I don't think you can look at the historical distribution of shock and to say, well, here's the typical persistence of a shock and so on. You have to really be I think very data dependent, to say we're not sure what's going on here. We're going to track closely, we will monitor, and we will try to respond in a careful way. So let me first of all say, when we think about forecasting the economy, it's very important that central banks keep the responsibility to give a baseline view. I think this is really what the outside world wants. They say, we understand there's uncertainty, but we still need you to work out what you think is the most likely path for the economy. So that anchor of the baseline is important. But then surrounding that baseline is to be explicit that you do have a risk assessment. So every monetary policy statement, we have essentially quite a long section where we list out the risk factors we are most concerned about. And this really is to signal to people that our baseline view can change quite quickly. And so the financial traders, firms and so on can keep an eye on those risk factors. I think it's important sometimes, not all the time, is to explore those risks with scenarios. So we've done it in the last few years, the pandemic, with Russia's unjustified invasion of Ukraine, with the Middle East conflict both in autumn 2023 and again this year, and then with the tariffs. So what we do is we publish our baseline, but we also say, here's where we think inflation and output is going under these alternatives. And then, maybe importantly, is to explain how our monetary policy incorporates the risk assessment. So 2 weeks ago, when we made our most recent decision, we said the decision was robust across a wide range of scenarios. So that's to provide reassurance that if the world turns out differently to our baseline, that we did think about it in advance, and we did check the decision would make sense even under the alternatives. So we've seen the price of oil fall in the last 2 weeks, but we included a scenario, a milder scenario where that happened. And so we were able to say the rate hike continues to make sense, even with this reversal in the price of oil in the last couple of weeks. And then maybe just to finish is maybe 2 more points. One is, again, to emphasize that in a world of uncertainty, it doesn't make sense to provide concrete forward guidance. We are more emphasizing our decisions would be based meeting by meeting on a data-dependent basis. But what is important is to be clear about what we're trying to do. And what we're trying to do is to make sure inflation always comes back to our 2% target in the medium term. So you have a clear orientation, but exactly the policy response will depend on the circumstance.
Thank you so much, Philip. Maybe just to follow up on this to Anna, and Philip was talking about the decisions that the ECB is making and the last executive member meeting. And in terms of the position of the MBS and the Central Bank of Serbia, because Serbia has quite a high ties in both real and financial sector towards the Eurozone, can you just maybe guide us on how the monetary policy decision-making process goes within the MBS? How much does it follow as a reaction to the monetary policy decisions by the ECB? How much it is independent, or it is something in between? Or in other words, how big are the monetary policy spillovers from the Eurozone to Serbia?
Okay, thank you. Should I do something? Yes. So, but before I answer, I would like to convey congratulations from our Madam Governor for the excellent organization of this World Congress. I had the privilege of being with her back in August 2024 when she met Mr. Nicandro. So back then she said that she will fully support Serbia's efforts to host this conference, and so she did. We had some technical problems back then. Mr. Vlahovic will remember, but eventually we reached it. So now, since we have the presence and the privilege of Mr. Lane being here with us, I will start with the conclusion that the ECB's monetary policy decision and the ECB monetary policy is extremely important for us. Or maybe to put it simply, if they succeed, we all benefit. So now the question of whether we react because the ECB reacts kind of assumes that small and open economies must choose between complete dependence on major central banks and complete isolation from them. So it is as we have to choose one way or another. And the reality is that, Milan, you mentioned somewhere in between. So the National Bank of Serbia has followed for many years this path. It means that we take external environment as an input, and better to say or precise, as an important input, but never as a task or instruction. So we are not member of the euro area, but we are deeply, as you also mentioned, connected with the Eurozone economy through trade, financial, and also investment channels. Euro area is, as many of you know here, our most important export and import market, so also the largest share of FDIs come from the Eurozone. Maybe to give example, that last year that was really marked with huge shocks. We even had from some Eurozone countries such as Germany, France, or Slovenia increased FDIs to Serbia compared to 2024. And this is why ECB decision for us do not end in Frankfurt. But, and I have to say but, this does not mean that the National Bank of Serbia does not conduct its own monetary policy. We do not make our decisions because someone else reacted. I can say quite the contrary. So, when we make our decisions, we look at domestic inflation, we look at domestic financial conditions, development in the foreign exchange market, we look domestic conditions, and of course, external environment, so as an important input, as I said, and then, and only then we make our decisions. So, to put this in numbers and facts, so we were the first central bank to react in the region, and maybe worldwide, when the first wave of inflation shock started, so we reacted in October 2021, so we used the flexibility of our monetary policy framework, so we started increasing first our average repo rate, at that time was at 0.11%, and we increased it gradually to 1% till April 2022, when it reached the key policy rate. And then we converged to reaction or tightening monetary conditions via the key policy rate. Also, if you look the latest cycle of monetary easing, it was in that started in mid-2022, we can see this divergence because ECB reacted on 8 occasions, reduced key policy rate by total 2 percentage points, so 200 basis points. In the same period, we reacted only 3 times, so decreasing the key policy rate in total by 75 basis points. And if you look the latest ECB decision that was made on June 11, so to raise interest rates by 25 basis points, I have to say that it was not a surprise for us. So it was expected decision, and we consider it an appropriate decision. But on the same day, and being aware of this expected outcome from the ECB meeting, we decided to keep our policy rate unchanged. And the reason is that we took into account the inflation movements and inflation trends in Serbia and inflation pattern forecasts within the monetary policy horizon. So, as I said, we conduct our own monetary policy, but not because we want to be different. We have our own assessment of what is in line with the conditions in our economy, and then we react according to them. But once again, and I believe that was mentioned, the fact is that our financial and economic, our business cycles are relatively closely linked because of our deep integration into the euro area market, and this is why it is no surprise that our phases of cycle are similar when it comes to the monetary policy decision, meaning that we are quite often going in the same direction. Also, in the case of Serbia and most other countries with their own currency and a relatively high level of euroization, which is also the case of Serbia, there is another strong channel and linkage. So we are talking about financial link through Euribor interest rates. This was a topic that was risen 2-3 years ago. As almost all stock of housing loans is indexed to the euros. And this is why the MBS is reacting to the ECB decision not only by monetary policy, but also by regulation and macroprudential measures. So, and we do so in order to prevent this I can say, huge external interest rate shocks to spill over to domestic borrowers suddenly and to spill over in a large scale. So, if I'm to conclude, I would say that the ECB decision and projections, I have to say, are an important part of our information set, but they are not, as I said, an order, nor instruction, nor directive for us, and there is no automatic mechanic rule. So if the ECB reacts, the MBS reacts. Of course that our monetary policies is not isolated from the international environment, but it is not also the copy of it either, nor it should be.
Thanks, Mana. And maybe to follow up on that, so how do you see in terms of the contemporaneous challenges now for the monetary policy environment across the Western Balkans? What are the key challenges from your perspective?
Thanks very much, Milan. And I just want to acknowledge also we have Sebastian Sosa, who is our representative for the whole of Western Balkans. So it's kind of, he can jump in.
No pressure, Sebastian.
No pressure, yeah. So Western Balkans is a region which
My colleagues also, they can also step in.
Western Balkans is a region which is subject to many challenges in terms of monetary policy making. It has a very diverse monetary landscape. There are 4 jurisdictions, Bosnia, Kosovo, Macedonia, Montenegro, that either use the euro, have a currency board, or maintain a very tight peg. So only Albania and Serbia de facto retain inflation targeting frameworks and active monetary policy instruments. But even here, even there, the room for maneuver is often more limited than it appears. And the key constraint is high euroization of economies. Recent IMF research confirms that high euroization reduces the effects of monetary policy. So the paper by Chen and co-authors, they looked at, in Europe, at the least euroized non-euro countries, such as the Nordic, and compared them to more euroized countries, such as in the Balkans. And essentially, in the least euroized countries, the effects of monetary policy were twice as high as in the most euroized countries. Now, the reasons are straightforward. It's that many loans would be either in euros or linked to the euro and therefore to the euro interest rate, and also that borrowers tend to try to arbitrage between borrowing in domestic currency and borrowing in euro as relative tightness of monetary conditions changes. Now, in addition to this, there are 3 other features that make the inflation challenge in the Western Balkans more difficult than that in the euro area. First, Western Balkans are converging economies. So by Balassa-Samuelson effect, they should have a bit higher inflation than the euro area. Second, inflation expectations tend to be less firmly anchored in emerging economies than in advanced economies. And the fact that euroization exists and that it affects monetary transmission also make the challenge of building credibility objectively more difficult. And finally, and I think also important in the current context, is that food and energy account for a much larger share of household spending here or in developing economies than, let's say, in Western Europe. And for this reason, again, we have a recent paper by Minasian and co-authors in the IMF who document that for this reason, food price shocks in the Western Balkans are more likely to spill over into broader price-setting behavior, making it relatively more difficult for central banks to look through such shocks in their monetary policy making. So, to sum up, Western Balkan central banks face more supply shocks, the risk of more persistent inflation, and potentially or likely weaker monetary policy transmission than other Western European, for example, jurisdictions. Now, what does it imply for monetary policy? Essentially, recent IMF papers, which inform IMF institutional view, point that in these circumstances, in response to shocks that may, that either can lead to more persistent inflation or in circumstances where inflation persistence is uncertain, this work, particularly by Brandao, Marquez and co-authors, they call for more active central bank policy than traditional models might suggest. So IMF is relatively more, let's say, hawkish in the current situation in terms of monetary policy. And also IMF puts more emphasis on communication, particularly on the communication of the reaction function. For example, that comes out in recent remarks, let's say, by Kevin Warsh for his country. So against this background, let me just briefly acknowledge the conduct of monetary policy in Serbia. The IMF's assessment is that the NBS stance is appropriately restrictive. We usually say it's broadly consistent, but in fact it's very consistent with standard Taylor rule indications. Following the inflation shock after Russia's invasion of Ukraine, thanks to NBS policies, inflation in Serbia has returned to target bands, and expectations have remained relatively well anchored despite this difficult environment. What we found particularly encouraging is the stronger emphasis in the most recent NBS communication about its reaction function, where the bank has communicated clearly how future decisions will depend on inflation expectations, wage developments, external shocks, and evidence of second-round effect. We welcome this clearly articulated reaction function. It's very much consistent with the IMF views of optimal monetary policy making in countries such as Serbia. And finally, to conclude this, let me also remark that as Serbia is navigating a relatively challenging or just challenging domestic environment and international environment, it's crucial to preserve the independence and credibility of the National Bank, both obviously formally, but more generally in terms of social and political support to the independent policy making of the National Bank of Serbia, because fundamentally, again, showing this credibility, independence, and social and political support would help in policy making, would help in communication, and would help better anchor inflation expectations in Serbia, which is the key to success of monetary policy in here.
Thanks a lot, Lev. And you made a great intro to what I wanted to ask Philip now, and we're focusing maybe now a bit on the risks. So we see that over these decades, there has been a much higher frequency of shocks and in some extent crises compared to the great moderation period that was before. And this also at the same time put much more emphasis on the central banks to be the first respondents essentially, and this is something also what you, Lev, mentioned to some extent. And then Philip, if this is first of all, is this the case that we see? And then second, if this is really, if the central banks are taking the role of the first respondents, then how this may impact, or what are the risks to central bank credibility and independence?
So I think it's important to differentiate across different episodes. Mm-hmm. So after the global financial crisis and the euro area sovereign debt crisis, what we essentially had was two challenges. First and foremost, in relation to financial stability, clearly there's a two-part answer here. Yes, the central bank has to play an important role in terms of liquidity. And as you indicated, liquidity provision is often the first step in responding to a crisis. But this is where our mandate is focused. So in terms of what had to happen at that point, in terms of reconstructing, if you like, the solvency of the financial system, that clearly is a fiscal project, not a monetary project. Mm. So what's important in those years is that the European Union and the European Union euro area governments established the ESM, which, if you like, is an official funding backstop for countries that get into trouble. And over the aftermath of that was to reconstruct the banking system to what is now a highly capitalized, highly liquid European banking system. What I would say also, it's very important to look beyond the banking system and also to keep a wider eye on macroeconomic imbalances. So what we have now is a household sector across Europe, which is much less leveraged than it was 15 years ago. We have a corporate sector which is also, has a fairly robust balance sheet. And we have a bank, as I said, the banking system also. So if you like, monetary policy can work a lot more easily if you have no questions about balance sheet. So this is why, I think for us to play our role, the wider system has to play its role in terms of building buffers, macroprudential policy, prudent fiscal policy so that fiscal sustainability does not come into question. And in that context, then the central bank can be free, if you like, to play its due role, both in terms of ex post liquidity when needed, but also ex ante clarification, like the OMT program, and more recently the Transmission Protection Instrument program. So remember Mario Draghi's famous words from July 2012. It said the ECB will do whatever it takes within its mandate. Both parts of that sentence are important. So let me say what the reason why there are differences. After the sovereign debt crisis, the global financial crisis, the aftermath of that was essentially a disinflation environment, connected with also other factors, but with a long period of inflation well below our target, which meant that we brought the interest rate to a negative zone. We had QE. We had large-scale refinancing programs. We had rate forward guidance. So all of that, if you like, was very important. There were questions in some corners about the role of those policies. So what was important is when we faced pro-inflation shocks more recently, that we pulled back from those policies and we hiked rates when we needed to. So in other words, the ECB has shown that it will be responsive in both directions with the overall commitment to delivering price stability. And again, to repeat, for the central bank to be unconstrained, if you like, in delivering price stability by being active with its policy instrument, we need sustainable banks, sustainable public finances, and again, prudent balance sheets of households and firms. So this is why, I mean, you can see what the threats to, from your question, to independence and credibility come from. It's not that I hope that we would have central banks who are not competent and don't know what to do. But if they are overburdened with external constraints, then you hit some difficulties.
Thanks, Philip. Lev, maybe just to focus on you now, on terms of the key risks, maybe what you see in the Balkans and in Europe. Maybe we can focus on the wage dynamics. How do you see the risk of wage dynamics influencing also inflation and having a backlash on it?
Thank you. Can you put up the slide which I gave you? Let me just, oh, here's the slide. So I just wanted to put this slide on. I think it's actually probably the most important slide that the IMF has produced on Western Balkans in the past year for sure. And these two charts, one of which shows the real wage to productivity ratio in the Western Balkans relative to CESI, excluding Western Balkans. And the other, which essentially mirrors the same dynamics, but in regard to real effective exchange rate in the euro area versus Western Balkans versus the rest of CESI. I think they tell a very important story and point to a potential risk factor, which is that before the pandemic, real wages in the Western Balkans, as you can see on the left-hand chart, broadly moved in line with productivity. And so was the case for real effective exchange rate, which were relatively stable, suggesting maintained competitiveness. But since 2021, both relationships have changed. Real wages in the Western Balkans are rising much faster than productivity, while real effective exchange rates have appreciated sharply. Now they have also appreciated in the rest of the CESI, but in the Western Balkans they have appreciated more sharply than in the rest of the CESIs. And this appears to be a structural shift, as you can see from this chart, which would have important inflationary implications, which is the subject of our panel today, but also looking, more broadly important implications for competitiveness. And there may be several factors for this shift, actually, but there is, on the other hand, there's several factors, I would say, for these dynamics. Well, the shift itself, I think, really requires more analysis as to why it has happened. So one factor for the dynamics is that, IMF has long documented that wage growth across the Central, Eastern and Southeast Europe has been running several percentage points above that in advanced European economies, and that in principle in this region wage formation tends to be more backward-looking, increasing the risk that higher wages feed into higher inflation, and then again. The Western Balkans share this pattern, but there are several factors which are specific to this region which make it even more acute. So first of all, there are labor shortages. Over the last 2 decades, the region has lost about 2.5 million people. That's equivalent to about 13% of its population, but even more in terms of its working age population, because most individuals or families that emigrate do it for employment-related reasons. And reading the recent IMF Article 4 reports across all the Western Balkan countries, essentially in each of them, this is acknowledged. All the reports point to labor market tightness as an important factor behind wage growth, which can in turn feed into inflation. Another factor which is concerning at the moment is the minimum wage policy. Minimum wages have risen rapidly across much of the region in the recent years. I mean, Serbia, as Serbian policymakers would know, is one example. Perhaps the most striking example now comes from the Federation of Bosnia and Herzegovina, two of the constituent entities in Bosnia, which had a 60% one-off increase in the minimum wage. Even from a low base, that's still a lot. Mm-hmm. Now, wage convergence, of course, is natural and desirable in the region that is catching up to European income levels. But the concern really, and I think that these charts very vividly illustrate this concern, is that when wages rise faster than productivity, firms face higher labor costs. This cannot be offset by efficiency gains, and the result is inflationary pressures. Again, going back to the IMF reports, in Serbia, the report discusses strong wage growth, which is contributing to services inflation. In North Macedonia, the report says that wage growth is an important driver of core inflation. In Montenegro, the IMF has emphasized the need to establish a stronger link between wages and productivity. In Bosnia, IMF highlighted large minimum wage increases, which raise concern about competitiveness and about inflation. In Albania, the IMF has highlighted the risk of second-round effects from tight labor market. So I think it really shows that it's a very important regional factor which countries need to get a grip of. Now, monetary policy by itself, it can help anchor inflation expectations and maybe contain some second-round effects, but it obviously cannot reverse demographic decline. It cannot directly respond to minimum wage hikes or in general to wage hikes. And monetary policy cannot directly raise productivity. So, the IMF view is therefore more holistic in a sense that the long-term solution to this spiral of wages and inflation that exists in this region is not a monetary policy solely solution, but it's structural, and that really highlights the importance of reforms to raise productivity. And usually we think about productivity in terms of macroeconomic convergence, but as this chart indicates that productivity reforms are also very important for cyclical stability, including monetary policy stability. Thank you.
Thanks a lot, Lev. And maybe, Anna, you can follow up on this. How do you see the inflationary risk at the moment in Serbia or maybe even in the region? So how much of the de-anchoring of inflation expectations do we see potentially, and how do we see the labor market dynamics influencing inflationary pressures?
Mm-hmm. Okay. Thank you. Maybe first two comments. I believe that Lev, during his first answer, partly answered this question when it comes to Serbia, and during this second, he was talking about the structural forces. So I believe that we will not overlap. I will speak from the other angle. Mm-hmm. But one thing is for sure, and I will talk first globally, and then I will switch to Serbia. And one thing is for sure that discussions about the second round effects of inflation expectations and labor dynamics comes back periodically. We had it in 2022 and in 2023, and clearly we have it today. So Lev knows that the National Bank of Serbia also hosted several IMF VO chapters presentation in the National Bank of Serbia, and I looked last night about two concrete chapters. So it was back in October 2022, titled Post-COVID Wage Dynamics and Wage Price Spiral Risks. Excellent one. And another was in October 2023, Managing Expectations, Inflation and Monetary Policy. So we from the MBS like to quote the analysis and conclusions from the IMF. So, and general conclusion back then was that long-term wage price spirals were rare, looking historically. Another was that the pandemic and the major price shocks in 2022 triggered an increase in near-term inflation expectations in a number of countries, while long-term inflation expectations remained stable for the most part, and this was related to the, I may say, earned credibility of the monetary policy. But what is different today if we compare it to 2022, and I believe that Lev also was talking about that one, I'm again speaking about the global level, are those sources of pressure. So in 2022, inflation was mainly driven by those large external shocks such as energy, food prices, supply chain disruptions, but they were then simplified, those supply side shocks, by the demand side shocks, meaning the strong post-pandemic demand and also tight labor market. Today, if we exclude this global energy shock, the risk is more domestic, as mentioned, and it is still gradual. So, inflation expectations are now much lower compared to the episode of 2022, and labor markets are less tight. This is quite important. So the question is whether the past inflation and wage dynamics and strong demand could slow down disinflation, and I will repeat, if we exclude the recent energy shock. And first conclusion could be that the risk is there, as mentioned, but it is more contained and easier to be managed than in 2021, so I'm speaking from the central bank point of view. The good news is that although wage growth has been quite strong in many countries in the previous period, as mentioned, not just the Western Balkans, but in many other countries, including, of course, Serbia, our analysis showed that the wage price spiral did not emerge, at least not yet, and this is one of the good news. Another good news is that numbers for Serbia do confirm this conclusion. So, our year-on-year inflation was at 3.5% in May, so slightly higher compared to 2.8 in March or 3.3 in April, and this correction was almost entirely the result of higher global oil prices, meaning that it was an external rather than a domestic factor behind it. Or, other words, we can say it was an exogenous shock, not the result of wage price spiral that we are talking about for the previous several years. But I have to say that increase in inflation in Serbia would have been much larger if our government didn't react swiftly with many measures that we have also communicated with the IMF, from reducing access on fuel or supplying the market from its own reserves. And what is important, because of the gained and preserved credibility of the monetary policy and also those swift measures of the government, inflation expectations of the financial sector has stayed anchored. If you look at our May inflation projection, we can see that inflation will remain within our targeted corridor until September. Maybe to mention that our corridor is 1.5 percentage points above and below 3% midpoint. Then it will temporarily, and we have communicated it transparently because the communication was mentioned as a very important channel of monetary policy. So it will temporarily and slightly exceed the upper bounds, and because of the mentioned energy price rise and also the low base effect from the last year, and then from mid-2027 it will return to our targeted tolerance band. But related to your question, it is also important that this expected outcome of inflation, meaning remaining within our targeted tolerance band within monetary policy horizon, will be supported and by the expected slowdown in real wage growth. This is something that we put as an assumption in our projection. Also, what is specific for Serbia, that our unemployment rate is now less than 9%. This is much lower compared to 15 years ago, but still it is slightly higher compared to the natural rate of unemployment, which we assess at 7.9%, so below 8%. And there is an excellent working paper done by our MBS colleagues, and it is available on our website on this occasion. And if you look the IMF macroeconomic framework for Serbia, we can see that the IMF assess our monetary policy as adequate. This is something that Lev mentioned, that we are very consistent with the Taylor rule. Actually, in October, they published the WIO. I saw the time. So we were the only, or two only central banks that had the monetary policy exactly at the level, key policy rate exactly at the level that would Taylor rule implied. So I say this because in the medium term, the IMF expects inflation in Serbia to be at the 3% target. This is what we also expect, but conditioned that the wage growth is in line with productivity growth. This is something that I have to say, condition on that.
Thanks, Anna. And maybe now to focus more on the central bank policies, the monetary policy frameworks, and the question for Philip. How do you see, I wouldn't call it traditional, but let's say monetary policy frameworks that have been in place for the past now almost 30 to 40 years, are they still relevant in the situations where we have that the most of the inflationary pressures, as we discussed also today, are coming from the supply side or from the restrictions on capital flows instead of excess demand, which is a more traditional channel of inflationary pressures?
Yeah, so I think you framed it correctly. So I would make a distinction between the monetary policy framework and then particular monetary policy rules. I mean, you've repeatedly cited the Taylor rule in the discussion this morning. And we also look at Taylor rules. But the Taylor rule is really implicitly based on demand-driven inflation. So when you have supply-driven inflation, it looks different. So by the way, there is a BIS study augmenting the Taylor rule with this difference between demand shocks and supply shock. So what you have to do is articulate a monetary policy framework that is more general. Mm-hmm. So in these years, we revamped our monetary policy strategy in 2021, and then we reviewed that and updated it in 2025. And essentially what we say is, the first step in monetary policy is to assess the origin, the size, and the persistence of the shocks we see. And if I focus in on supply shocks, let me walk through the different cases. So number one is if the supply shock is relatively limited and is not expected to last too long, then the traditional classic recipe of looking through the supply shock remains, I think, valid. However, please remember when you think about that case, and you think about, again, over the decades, what people think about when they think about supply shock, quite often it might have been some kind of, for example, in agriculture, a failed harvest. Or, again, a natural event that interrupted supply temporarily, and which can create volatility. That, I think, is straightforward. Mm-hmm. A second polar example is a very large disruptive supply shock. And I think here the dynamics in the price of gas after the Russian invasion of Ukraine is instructive. So if it becomes really large, and I think as Anna already indicated, at that time, the interaction effects were amplifiers. Because at the same time in 2022, we had the reopening of the European economy after the pandemic. So there was kind of fairly inelastic demand for tourism, for entertainment and so on. So in that case, you go into a category of a large shock creating nonlinear dynamic. And so what we said there is, in that case, we need to be quite forceful and or persistent, like being restrictive for an extended period to respond to the shock. So in other words, above a certain threshold, regardless of whether the origin is supply or demand, high inflation in itself is destabilizing. Because, of course, there's going to be significant wage catch-up effects for several years after that. So then let me turn to the third category, which is where we are now, which is essentially a mid-sized supply shock, which is expected to be somewhat persistent. So in other words, even though now the price of oil is falling, the 4 months of elevated oil prices has, if you like, percolating through supply chains. And so we do think it means inflation, you know, around or above 3% into next year. So that is neither short-lived, nor is it forever. And what that means is essentially to have a kind of calibrated or measured monetary policy response. So I think the framework can, in the sense of inflation targeting, can handle a range of shocks. But I think we have to be clear that when we say inflation targeting, it's the commitment to bring inflation back to target in the medium term. It's not to suppress all volatility in the inflation rate. And of course, for a large continental-sized currency area like the euro area, that's an issue. It's, I'm sure, an even bigger issue for a smaller economy, especially as Lev indicated, if the price or the expenditure share of energy and food is a lot higher than it is for the euro area. But then also maybe just to also touch on another topical topic, it's also important to think about not just the supply shocks that are happening right now, but also to recognize the economy is also responding to the anticipation of future supply shock. So in particular, I have in mind AI. So right now, we don't think AI yet is pushing up productivity in a dramatic way. But I think we would see possibly productivity picking up in the years ahead in a noticeable manner. So when we also have to think about, okay, how does the economy respond in anticipation of a future supply improvement? And of course, in the near term, demand may respond now because of the investment needs to take advantage of AI. So there's a build out, around the world for that reason. So where I started of having an easy distinction between demand shocks and supply shocks, when you expand the analysis to include anticipation of future supply shocks, then you get this mixed type of shock, which is both working on demand and supply. Let me stop there.
Thanks a lot, Philip. Maybe because we are also closing to the end, Anna, can you just address a bit on something also that Lev shared, and this is the real exchange rate appreciation that we see, but from the other point of view about the exchange rate policy, because we've seen that the euro-dinar exchange rate has been quite stable over the past long period, and there's been always some advocacy for stronger nominal depreciation. And what would be your stance with respect fueling export price competitiveness story from the nominal exchange rate?
So thank you, very nice question. And I will speak fast because this is very important question for us. So, and to be honest, I saw it coming and I put my thoughts on the paper and I divided my answer to two parts, one theoretical, one practical. So the proposal or advice, or however we decide to call it, that Serbia should allow the dinar to depreciate in order to support export or export competitiveness is one of those proposals that maybe sound convincing in a textbook model. But it comes highly problematic or irrelevant when it is applied to Serbia, which is neither a closed economy nor a non-euroized economy. And I will try to support this with arguments. We have heard, and during this conference, that history gives us a warning. I particularly like the presidential address by Professor Halpman. So countries that resorted to aggressive depreciation in order to buy export competitiveness have most often ended up with importing inflation from abroad. Then that erases any nominal benefit, and I will say if any, with just a few quarters, but at the same time it raises the confidence. On the other hand, small open economies that have built credibility through exchange rate predictability has shown that it is not forced depreciation, and I will call it forced depreciation, that enables medium and long-term planning and supports exports. It is predictability and stability that are the real driving factors behind it. So our question is, why depreciation would not work in Serbia in the way that it works in a textbook? One of the reasons, and I believe it was mentioned by Lev, is the structure of financial balance sheets, and we have discussed this also by the MBS, this issue a lot in public. Serbia has still a relatively high level of euroization, so it has decreased significantly over the years. This is quite important, but remains relatively high. So significant share of housing and the corporate loans is still indexed to euro. In such conditions, any effect of the forced depreciation on export competitiveness, I will explain later why I say forced, would be first limited, second, it would be short-lived. At the same time, the impact on balance sheets and confidence would be first immediate, second significant. So in the past, we had seen this channel working because we had the NPLs at the level of more than 20%, closer to 25%. Today, they are 2%. There is also another channel of imported inflation. I mentioned it at the beginning, but also Lev mentioned it. Under conditions of the relatively high level of euroization, so depreciation would quickly pass through the domestic prices via the prices of imported goods such as energy, raw materials, equipment, etc. And this is also the channel that we have seen in the past. But there is also the structure of our exports with a relatively high import component. It means that the forced depreciation would tackle only this small part of the net export. So not whole export, just this small part of net exports. Also, we have discussed this issue quite a lot in public. Now, if you look at the numbers, we can say that provided relative stability and kept relative stability of the dinar exchange rate against the euro. I'm constantly looking at my colleagues here. They are a part of the executive board of the MBS. So it has not prevented the exports growth. It was quite the contrary. We have seen export of goods and services growing by an average annual rate of 12% over the previous decade. Also, this coverage of the imports of goods and services by their export was at 92% last year, so historically high. On the top of that, when we hear proposal that the National Bank of Serbia should allow depreciation of the dinar in order to support exports, our question is how exactly and why? Since 2017, the MBS has been on the net buying side. So we have bought more than 10 billion euros on the interbank FX market. So it means that we were predominantly easing appreciation pressures, as you well acknowledged, not the depreciation. And that is the reason why I called it forced depreciation. And if I may take only 1 minute to conclude, I would say that the exchange rate should not be used as an instrument for creating an illusion of competitiveness. If competitiveness is based on weak currency, it lasts only until the next wave of inflation. If it is based on productivity and stability, then it becomes part of the long-term growth. I wanted to once again go through the numbers, but I will leave my time to Lev. Just maybe to say that this proposal would be a bad solution from the wrong book for our economy. Here I will stop.
Thanks a lot, Anna. Lev, do you mind if we take some questions from the audience and then we can come back? If there's any question from the audience, just to pause it here and leave it for 1 or 2 questions. If not, then we can follow up. So if not for now, let me just maybe focus. If you want to have some reflections on it, or just
with pleasure. No, look, I mean, I broadly agree with what Anna has said. So as many of you would know, the MF orthodoxy in general speaks about flexible exchange rate as shock absorbers, speaks about high buffers and to manage shocks. But I think that there are several aspects there which make, Serbia, Western Balkans a more different case. So first of all, I need to say that, IMF and its Article 4 surveillance assesses for the economies their external sector stability, and in particular whether the exchange rate of a currency is broadly in line with fundamentals. And according to the recent IMF report, the exchange rate of the dinar is broadly in line with fundamentals. I think also I agree with Anna that the idea of depreciation for the purpose of competitiveness has nothing to do with the idea of flexible exchange rates, as they should be as shock absorbers. But then I think there are two additional observations which, kind of make Western Balkans a bit special in terms of IMF orthodoxy. First, on exchange rate regimes, I think if ain't broken, don't fix it. Altering an exchange rate regime when you start to, either like countries in this region with a currency board, a peg, or something like that, is often risky and can in and of itself become a source of instability. Second, there are anecdotes about Robert Mandel's visits to the region, to Serbia in the early 2000s, and like all good urban legends, they're undocumented. But according to these urban legends, he basically said that Serbia and Western Balkans certainly, they belong in an optimum currency area with the euro. Now, whether or not one agrees with this, it reflects reality that it's hard to ignore. The region is deeply integrated with the euro area through trade, finance, remittances, and euroization. And so it's not surprising that many all Western Balkan economies to some extent have chosen exchange regimes that are, linked to the euro, and that these arrangements in general in this region have delivered macroeconomic stability. I think that's where I would say on this.
Thanks a lot, Lev. Anna, do you want to say something? Or follow
I
up?
just wanted to add something that maybe Nicola also can add, that psychology. If you let the exchange rate in a relatively high Eurozone economy, then you can expect withdrawal of the deposits from the banks, etc., etc. So if it is good, if you let it in one direction, it is not good for exporters. Another direction, not good for importers. Not good for those who have credits or for those who have savings. So this, what we have found within the inflation targeting regime, we believe suits our economy best, and results really prove that.
Thanks, Anna. We have just 30 seconds or more, so we have time for one quick question, if there is any.
Misha.
If you don't mind, a question would be for Mr. Lane.
Absolutely. Please go ahead.
Yeah, considering the underlying price pressures and the persistently strong core inflation in the Eurozone, my question is it more likely to see monetary tightening in the third or in the fourth quarter? Thank you.
So before the war, what we had is essentially that this year would see a further decline in wage inflation, and in turn that would unlock lower services inflation. So under the pre-war projections, I think there would have been, if you like, further improvement in core inflation, and so this backdrop is important when then you try to think about how the energy shock may kind of spill over into core inflation. So in our June forecast, we did say there would be some degree of pass-through, and we do take that into account. But let me come back to the overall theme of this session, which is basically we'll be observing all of that meeting by meeting in a data-dependent way. So, I know it's an interesting question to ask, but we are kind of resolute in avoiding trying to give indications of future rate decision. We need to respect the uncertainty, to respect how the data will evolve, and so I'll tell you the answer at the end of the year.
Thanks, Philip. And with that, I will close this panel. Thanks very much again for the panel participants. Thanks a lot, Philip, for joining us online. and it was a pleasure to discuss monetary policy issues and challenges at the moment. And see you at the conference, guys.